Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and an extremely timely video for you today. Nation, with COVID cases topping 200,000 a day last week and distribution of a vaccine still at least a month away, the market could be in for a very difficult few months. It's times like this that I'm looking for some certainty and safety in my portfolio. And while shares of utilities have been hit hard this year on lower commercial demand for power, as a regulated industry, profits are about as safe as it gets, and the dividend yield is among the highest in the markets. So as that uncertainty heats up for the rest of the economy, utility stocks should provide some of that safety that we're all going to need. And looking out further into next year, there's some real value locked away in this sector. The average price-to-earnings ratio on utility stocks is just over 18 times. That's about 14% above the long-term average, but well below the premium we see in a lot of these other sectors. Earnings growth in the mid-single digits combined with dividend yields twice the market average should provide for a strong investment in 2021. Now that's the sector. Researching deeper into these individual stocks though, I found 5 with an average of 4.7% dividend yield, almost 3 times the market and 50% above that sector average. I'll be putting one of these stocks into our 2021 Bowtie Nation portfolio on Stock Card, already up 22% in the past month. I'll be doing an update video on the portfolio next month, but I'll also leave a link in the video description below if you want to check out those current picks. Don't forget to use the promo code BowtieNation for an exclusive discount beyond that free trial as well. Our first utility stock here, Duke Energy, ticker DUK, just announced a major clean energy investment that could really drive growth. Management's 5-year capital plan is focusing on those renewals with a target of net zero methane emissions by 2030. Beyond an aggressive plan for growth, the company's expense reduction program has been one of the best in the industry, shaving $350 million in costs through last quarter of this year. In fact, the restructuring was enough to help the company beat earnings estimates by 4.5% last quarter, even with a hit from abandoning the Atlantic Coast Pipeline project. Those cost reductions achieved are 75% of the total plan, which means there could be another $1 million plus in savings. That should help management achieve its earnings target of $5.10 per share this year. That puts the shares at 18 times on a price-to-earnings basis, which is right around that sector average. Now, the record hurricane season shaved 10 to 15 cents off those earnings this year, so given the further cost savings, I think 2021 earnings should be surprising on the upside. The average analyst price target here is just below the current price, but likely gets upgraded when we see some of those 2021 earnings estimates coming in. Now, I would expect a healthy 5 to 7% price return on this one, along with that 4.2% dividend yield. I think this next utility offers not only the best dividend out there, but also the highest price upside, First Energy, ticker FE, and its 5.5% yield. And the company is a fully regulated utility with 6 million customers across 6 Mid-Atlantic states and over 24,000 miles of transmission lines. Management here is forecasting 10% annual transmission rate growth through 2023 and 4% annual growth for distribution. This is one of the most stable cash flows in utility stocks, and the shares would be higher except for one little legal problem lately. The company terminated its CEO in October and saw its bonds downgraded on governance concerns that have really hit the shares. The Department of Justice has implicated First Energy as the source of about $15 million in funds used by a former Ohio speaker in a bribery case to benefit 2 of their nuclear plants. Now, the investigation is ongoing, but I think the worst is really baked in here. The outcome, good or bad, shouldn't materially affect the company's bottom line, and the headline risk has really created an opportunity in a super cheap stock. The company is expected to report $2.59 in per-share earnings over the next 4 quarters. That's just slightly below the $2.62 reported over the last year. Now, that would put the shares at a price of just 11.2 times earnings, one of the cheapest in the sectors. The average analyst price target of $37 a share here is almost 27% higher than the current stock price, giving First Energy the highest upside in our list. In fact, I added First Energy to our 2021 Bowtie Nation portfolio on Stock Card. We're just 6 weeks into the portfolio and already beating the market by 18% with a 22% return so far. Click through and follow the portfolio on Stock Card. It's totally free to follow, and you'll get trade alerts anytime I buy or sell from the portfolio immediately and even before these videos come out. As a special bonus though, I've negotiated an exclusive discount for everyone here in the community. Use the promo code BowtieNation, all one word and lowercase, and you'll get a special discount beyond that 2-week free trial. Consolidated Edison, ticker ED, provides service to 10 million customers, mainly in New York and New Jersey, but also has a solid solar business nationally. There are some great catalysts for growth here, but what really attracted me to the shares was 46 consecutive years of dividend increases by Con Ed, with a yield of 3.9% right now. Now that's pretty astounding, especially considering some other utilities are having to pause their dividend increases this year. 56% of the company's electricity comes from renewables, and it's the second largest solar generator in North America. Con Ed also owns a 12.5% interest in the Mountain Valley Pipeline and 50% of the Stagecoach Pipeline. Now, neither of these really fits with the core business model. The Mountain Valley Pipeline assets could get a pretty good price in a sale, especially after that abandonment of the Atlantic Coast Pipeline by other utilities recently this year. The company is expecting to book $4.40 in earnings per share over the next year, an increase of 3.5% over this year's earnings. That would mean a 17.5 times multiple on that PE ratio. It's not the lowest here in this list, but it's still pretty decent growth considering how the pandemic has hit that power demand. PPL Corporation, ticker PPL, is one of the larger utilities and the highest dividend payer of the group with a 5.7% yield. Now, PPL has $46 billion in assets and international exposure with its UK business. Management did announce plans earlier this year to sell the UK segment to focus on its business in Pennsylvania and Kentucky, and I think it's a great move that could unlock a lot of value here. Funds from the sale are expected to go to strengthening the balance sheet and growth projects, so this company should have ample cash for several years. Now, regulatory changes in the UK had really made it a weight on the rest of the returns, so an expected first half 2021 sale could see the valuation on this stock bump up for the shares. Right now, the shares are trading for just 12 times on that PE basis, so definitely some upside potential here if it can get re-rated right around 15 to 18 times multiple after the sale. Southern Company, ticker SO, is the largest utility in our list at a market cap of $64 billion, as well as the highest expected earnings growth. The company services 9 million customers in 9 states, but does most of its business in Alabama, Georgia, and Mississippi. Now, this is another one undergoing a huge transformation into that renewable space and just saw its largest one-year shift from coal into renewables and nuclear. And after 5 years of setbacks, it looks like the new nuclear plant in Georgia is finally set to meet its late 2021 in-service dates. Now, that alone isn't going to add to next year's earnings, but after cost overruns and that schedule, that's going to remove a lot of the uncertainty around this stock. And even before that plant starts adding to the earnings, though, Southern is expected to post the strongest earnings growth in the group. Earnings are expected to pop 6.2% next year to $3.24 per share. The growth is a little expensive at 18.8 times on a PE basis, but it's going to be well worth it if the company can keep up that pace. Look for that link in the description and follow our 2021 portfolio on StockCard. Click on the video to the right for the first 5 picks in the portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.